Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. And this is Ryan Nauman, the market strategist here at Zephyr. I have another very special episode lined up for us today. Now, as you probably know, the IMN Real Estate Family Office and Private Wealth Conference is fast approaching on June 5th and 6th in Dana Point. And the excitement is building for this must attend event that connects capital with real estate. Well, I'm very fortunate and honored to have on a very special guest who is the event's keynote speaker. Before we get started, though, this episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Ronald Diamond. Ronald is the chairman and CEO of Diamond Wealth. He is also the founder, host, and CEO of Family Office World Media. Ron, thank you so much for coming on. It's an honor to have you on. And can you just start by telling us a little bit more about yourself and Diamond Wealth?
Sure. Well, first, thank you for having me, and it's great to be here. Diamond Wealth, basically, we have it's a syndicate. I have about 123 family offices that we invest together. These are families anywhere between 250 million up to 30 billion, and we invest in the private markets, so private equity, venture capital, real estate, predominantly private equity and real estate. Real estate probably the largest one. So that's the main thing that I do. Then I sit on some advisory boards. Um, teach. I am involved with. I helped to set up the Family Office Initiative at University of Chicago at Booth, which we just launched. I did it at Stanford about 4 years ago, and then I run the Family Office Group for Tiger 21. So those are the kind of the four things that I do.
Fantastic. You're busy, Ron, is what you're saying. You're busy. Your
I'm
plate is
busy.
full.
I'm busy, but I enjoy I love what I do.
Fantastic. Let's start off by talking about the upcoming keynote address that you have at the IMN conference in a week. Without giving us the entire presentation and giving it away, maybe tease us a little bit here, maybe provide us with a little glimpse of your presentation and what you plan on talking about.
Sure. Well, it's a fascinating time to be in real estate and also to be in the family office space. So let me kind of backtrack for a second about family offices. Currently, family offices today control approximately $10 trillion in capital.
Okay.
And there's about 124 trillion that's moving downstream from the baby boomers to the next gen in the next 20 years. So we're about to experience the largest transfer of wealth in history. And that's going to fundamentally change how companies are financed. And specific to real estate, it's going to fundamentally change how a lot of these people fund their deals. So right now, a lot of the people who are raising money in real estate, they'll go to high net worth individuals, they'll get checks for 100,000, 250,000, 500,000, and syndicate it and raise whatever it is they need to raise. The other option is they go institutionally. The family office market, I think right now is probably the most attractive market for family offices to raise money from because at the end of the day, we've got a tremendous amount of capital right now. Real estate is a number one asset class for family offices. And one of the interesting things is post crash, pre COVID, a lot of family offices wanted to go direct. And their thought process was pretty simple. Um, Remember, post crash, pre COVID, I don't care what you invested in, it went up.
Yeah.
Private equity, venture capital, real estate, Bitcoin, the stock market. And with interest rates at zero, it's never easy, but it's certainly easier to make money
Yes.
in real estate. Well, what happened was a lot of these people bypassed the professionals and said, well, if I can make money, why should I invest and pay 2 and 20? And they were right until they were wrong. And what happened was about 3 years ago when they started jacking up interest rates, all of a sudden real estate wasn't such an easy game. There was a lot of complexities to it. And it was the first time a lot of these families have seen a downturn. So what's happening right now is a lot of families that did direct deals are not only not making money, they're actually losing money in real estate. So I think there's going to be a pushback, and I think it's a great opportunity for sponsors to invest because family offices now realize there's a skill set to doing what these sponsors do.
I'm really glad you brought up that wealth transfer. We deal more, a little bit more on the wealth management side, retail side, downriver a little bit more downstream, but it's still impacting the family office side too. And it's a big topic um, for us also for the investment advisory space. Why? you know, are you guys still contending with, trying to connect with the younger generation? Is do you still have that issue? Or with family offices, do you bring, though, is it easier to bring the younger generation into your office more often, start that relationship sooner? Is it a little bit easier transition than maybe, say, in the more retail investment advisory space?
No, it's not easier. It's very
Okay.
challenging. And I mean, the model itself is so only 25% of family offices make it to the second generation, and 10 make it to the third, and 5 make it to the fourth. So the model is flawed. It's a very inefficient, very fragmented, very siloed, and very opaque market. And it's not institutionalized or professionalized. I think that's starting to change. And when I helped to create the program at University of Chicago Booth, the Family Office Initiative, that's part of the reason we did that because we need to really professionalize this because family offices right now have a tremendous amount of money, but in general, a lot of that money is what I would say is in inefficient hands. I think that's going to change, and I think we're starting to see the professionalization of family offices, and that's what we're trying to create at Booth.
That opened my eyes up, Ron. I knew this conversation was going to be, I was going to learn a lot. And you just started it off right there. I thought that's interesting that it really slides through the generation. What do you guys know? I know you say professionalization and stuff like that, but are there other reasons why maybe those as the generations go through the family tree, they leave?
Well, there's a whole bunch of different reasons. I mean, first of all, um, the speed at which you can create wealth today because of technology. I mean, it used to be the first family offices in the U.S. were Vanderbilt and Rockefeller in the late 1800s, and but that it took generations to build that wealth. Today, you can create an app. A 26-year-old can create an app
Yeah.
and create instant liquidity. So I think the speed at which it can happen. So you see a huge amount of capital happening very, very quickly. And with the great wealth transfer of $124 trillion, that's really it's a very challenging part because how does that work? I mean, what if G1 doesn't want to give up reins? What if G2 isn't qualified to
Yeah.
run the family office? What if G2 has three family members and two are equally competent and they both want to do it? There's a whole bunch of things. So I think a lot of this has to do with psychological
Mhm.
issues. It's as much about EQ as it is. It's probably more about EQ than it is IQ.
Yeah. Interesting. Talking about investments, you mentioned like at your family office, you focus on the private markets, private equity, venture capital, private real estate. Well, interesting. UBS just released their global family office report for 2025, and they mentioned in there that family offices are going to start, they think, moving in the 2025 based on their survey the allocations to public equities is going to increase to 29%, while allocations to private equity are going to decrease. What do you think is driving that? Because usually when you think of family offices like you think of a lot of private equity, private markets. It's shifting here. What do you think is driving that?
Well, I don't necessarily buy that. I mean, I
Okay.
understand. I read the study and it was a limited study. It wasn't
Mhm.
they didn't interview everybody. And the samples, I don't know who the sample size was, but look, in
Think it was
general,
320-ish.
right. So there's roughly 10,000 family offices throughout the world. So look, at the end of the day, it's hard to interpolate everything, but I do think that in general, fewer and fewer companies are staying public, and more companies are going private, and they're staying private longer. And what's happening is the private companies they're creating the alpha before they go public. So I see for family offices an actually increase in the private markets, not in the public markets, which is contrary to what that study showed.
I love some contrary thoughts there. So it's interesting. And the report kind of, opened my eyes too, because, you often think, like I said, family offices really in the private markets, alternatives. going that route. So that kind of surprised me some, especially all the uncertainties in public markets and markets in general. You know, they say 55%, or somewhere over half of family offices and investment portfolios are made up of alternatives. The biggest piece, like you said, is private equity, and the second largest of that alternative sleeve is real estate. Why do you think real estate is such a big piece there? Is it, why is it so popular?
It's not complicated. It's been very profitable. It is very profitable and will continue to be very profitable. Obviously, it's a challenging market today, but in general, a lot of the wealth that's been created by a lot of people in this country is from real estate. It's been a very, very attractive asset class. So the reason is strictly performance.
Yeah.
It's also hedge against inflation as well.
Yeah. Well, speaking of that and the economic side, it's an interesting cycle for financial markets. We have an abundance of uncertainty. The economy is slowing, increasing yields, mortgage rates still remain elevated, even though when you look at historically, maybe they're not so inflated, but from what we're used to, they're inflated. What does this environment mean for family office who might be looking to deploy capital to real estate or maybe increase their exposure to real estate? What impact does the current market environment have on these family offices?
I think it's a great market for family offices now to invest in real estate because remember, a lot of these family offices that invested in real estate that didn't make their money in real estate. They weren't professionals. They're in over their skis. They went into multifamily or office or whatever they asset class they invested in, and now they have to refinance their deal, and they don't know how to do that. And so
Yeah.
it's a period of time where I think there's going to be a backlash where family offices previously started doing things more themselves because they were myopic and wanted to save money on fees, which makes sense until it doesn't. And 3 years ago is when it started not making sense. So I think right now it's a wonderful opportunity for people who are raising money in the real estate sector because family offices always have and always will invest in real estate, and
Mm.
now is a very good time. And there's a lot of right now there's a lot of good opportunities to get in, whether it's multifamily, student housing, self storage, medical, data centers. There's a whole bunch of different asset classes. The only thing we don't touch is office.
You don't touch office. Interesting. Okay. That was going to be one of my questions. The perfect segue is to the different sectors of or different areas of real estate. One of the hottest ones, and you just mentioned it, was data centers, um, and rightfully so, with technology. You mentioned a few others. Are there other parts of the real estate market that you find attractive, and maybe you can talk about why?
I think build to rent is going to continue to be. It's been attractive, and I think it's going to continue to grow. I think the demographics of this country. It used to be, 20 years ago, if you could afford to buy a place, you bought it, and if you couldn't, you rented. Now it's a lot different. So let's look at the younger generation. If you're under 30, you're going to probably, from the time you graduate college till the time you're 30, you're going to probably have 5 different jobs. So if you're in that age bracket, even if you could afford it, why would you buy a place when there's a good chance you're not going to be at the same job or possibly the same location?
Yeah.
So that's the younger demographic. Now, the older demographic, again, it was very simple. Previously, you could afford, you buy. If you can't, you rent. But now I think people want more flexibility and people are traveling more and renting the that's just what's happening. So I think we live in a society where the multifamily offices, even though it's been a challenging time for the last couple of years, I do think medium and long term is a fabulous market because people need places to live.
Yeah.
And I think that the rental market is going to continue to be the biggest growth driver in the real estate market.
Interesting. With this very dynamic and fluid financial markets that we're in right now, has that really changed your investment criteria when it comes to searching for real estate investments? Or is it, time tested? You stick with a high conviction in your criteria, or does it change with the market?
It doesn't really change. I mean, it gives us certain opportunities, more opportunistic opportunities, because there are some times where things are a little bit distressed, and then we have an opportunity to come in. and get things a little cheaper, sometimes cheaper than replacement costs. So there are opportunities here, but we don't change our thesis. I mean, we typically invest with we've got a syndicate of 120 families, and most of the deals come from family offices. So the family office might take 150 million dollars of a deal. They have 50 million left. We'll take the other 50. So that hasn't changed.
Interesting. So you mentioned at the opening your family, and it's a syndicate, so I'm assuming a lot of co-investing, right? Like you're talking about, there's other ways to invest in real estate as, invest directly or through funds. What should family offices consider when they're deciding what vehicle to use?
Depends how sophisticated they are. So if they made their money in real estate, that's one thing, which some people did. If they didn't make their money in real estate, they really have to, they shouldn't invest direct. I mean, there's a skill set to being in real estate. And if you made your money in real estate and multifamily and you built a family office, yeah, you could go direct deals and you could do it yourself. But if you made your money in tech or you made your money in manufacturing widgets or whatever it was,
Yep.
and you're not an expert in real estate, you really need to rely on somebody who's an expert. And I think those funds will continue to gain traction.
Yeah. Fantastic, Ron. I knew I was going to learn a lot coming into this conversation. I did. It was really good conversation, fun. Thank you so much for coming on. Where can our audience get more information about Diamond Wealth? Okay.
Familyofficeworldmedia.com is one area, and then I'm fairly active on LinkedIn. So familyofficeworldmedia.com or through LinkedIn is usually the easiest way.
Ron, thank you so much for coming on and sharing all the great insight. You can also get more information about the upcoming IMN Real Estate Family Office and Private Wealth Conference and other IMN events at imn.org. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Also, please be sure to subscribe and follow us on LinkedIn. Thank you, and have a great rest of your week.